All right, class, welcome. Today, we're going to dive deep into a topic that, on the surface, might seem like just another accounting rule. But I want to show you how it actually tells a fascinating story about a company's health, its strategy, and even the quality of its leadership. We're talking about a company's physical assets. The machinery, the buildings, the delivery trucks that are the real workhorses of the business. We're going to explore how their value changes over time, both in predictable ways and through sudden shocks, and what that reveals to us as financial analysts and future business leaders. Understanding this isn't just about passing an exam, it's fundamental to making sound business decisions.
So, here's our roadmap for today's lecture. First, we'll establish the foundation. What exactly are these physical assets we're talking about? Then we'll unpack the two key concepts for how we account for their value over time: the steady, planned process of depreciation, and then the sudden, unexpected event of an impairment. From there, we'll look at it from a manager's perspective. How do they actually handle this? And finally, we'll tie it all together to understand why this balancing act is so incredibly important for a company's long-term success.
Okay, so let's start at the beginning. Let's talk about the physical foundation of any business. These are the tangible, long-term assets that a company uses day in and day out to actually create its products or deliver its services. Think about the massive robotic arms on an automobile assembly line, or the fleet of airplanes for an airline, or even the building that houses a company's headquarters. These are the tools that generate revenue.
Now, in accounting, we have a formal term for this: plant assets. You'll also hear the term property, plant, and equipment, or PP&E for short. Now, for an asset to be classified as a plant asset on the balance sheet, it has to meet a few specific criteria. First, it's long-term, which means it has a useful life of more than 1 year. Second, it's tangible. You can physically see it and touch it. And third, and this is a really important distinction I want you to remember, it must be used in the operation of the business. It's not something the company plans to sell to customers. For example, for a car dealership, the sedans and SUVs on the lot are their inventory, but the tow truck they use to service customers' broken-down cars, that's a plant asset. See the difference? It's a crucial one.
It's really helpful to think of these assets as the physical engine of the business. They drive everything. But just like any engine, there's a fundamental economic reality we can't ignore. That engine wears out over time. From the very first day a new machine is switched on, it begins a slow process of losing its value. It gets used, it suffers wear and tear, and sometimes it just becomes technologically obsolete. This isn't a maybe, it's a certainty, and our accounting system absolutely must reflect this reality.
So, that leads to the big question. How do we account for this steady, predictable decline in an asset's utility? Well, that brings us to one of the most fundamental concepts in all of accounting: depreciation.
Now here is the single most common mistake students make, and I want you all to avoid it. Depreciation is not the process of trying to figure out an asset's current market value. We are not trying to guess what we could sell it for on eBay. Instead, depreciation is all about cost allocation. Think about it. When a company buys a $1 million machine, it would be misleading to report that entire $1 million expense in the first year. Why? Because that machine is going to help generate revenue for, say, the next 10 years. So we use a core accounting idea called the matching principle. We systematically allocate the cost of that asset as an expense over the same periods that it helps us earn revenue. It gives us a much truer picture of a company's profitability year after year.
Let's walk through a simple example. Let's say your logistics company buys a new delivery van for $50,000. You estimate it'll be useful for about 5 years. Using the most common method, straight-line depreciation, you take that cost and divide it by 5. So each year, you'd record a $10,000 depreciation expense on your income statement. This expense lowers your reported profit, which, by the way, also lowers your tax bill. Now, at the same time, over on the balance sheet, the value of that van, what we call its book value, is reduced. This is done through a contra-asset account called accumulated depreciation. So after year 1, the van's book value is $40,000. After year 2, it's $30,000, and so on. It's a steady, predictable, systematic march.
But here's the thing. Business isn't always a steady, predictable march, is it? Sometimes things happen that throw a giant wrench into our careful plans. And that's where we have to introduce our next crucial topic: impairment. This is where accounting gets really interesting, because it's where the numbers have to react to the chaos of the real world.
So I want you to think about this. What if a brilliant inventor creates a revolutionary new 3D printing technology that suddenly makes your entire factory of traditional machines obsolete basically overnight? Or what if a major fire or a flood severely damages your warehouse?
Or what if consumer tastes dramatically shift and suddenly nobody wants the product that your highly specialized machine was built to produce? Normal, slow, and steady depreciation just doesn't capture these sudden, often catastrophic drops in an asset's value. And this slide right here perfectly captures the difference. Depreciation is the planned, gradual, systematic allocation of cost over time. It's expected. Impairment, on the other hand, is an unplanned, sudden, event-driven shock. An impairment is a one-time write-down that a company is forced to take when an asset's carrying value on the books, that's its original cost minus accumulated depreciation, is determined to be no longer recoverable. In plain English, it means the asset is not going to generate enough cash flow in the future to justify the value we're carrying it at on our balance sheet. It is essentially the company's formal admission that a past investment decision has turned out to be a bad one. It's a financial reality check.
Okay, so if you're a manager, how do you navigate this landscape? How do you deal with the certainty of depreciation while always being prepared for the potential shock of an impairment? Well, the key is that this cannot be a passive activity. It requires diligent, active management. And let me be clear, this is not just a task you delegate to the accounting department and forget about.
This phrase right here is a critical takeaway for all of you as future managers. Managing a company's physical assets is a core responsibility of senior leadership. It involves strategic planning for new investments, setting realistic depreciation schedules, and, most importantly, maintaining a constant vigilance for any potential signs of impairment.
So what does this look like in the real world? Well, it means management can't just sit in their offices. They have to constantly ask the tough questions. Are our machines still operating efficiently, or are maintenance costs getting out of hand? Is there a new technology on the horizon that could disrupt our business model? Has the market for our flagship product fundamentally changed? You see, accounting standards actually require companies to test for impairment whenever one of these triggering events occurs. Ignoring these signs is not an option. It's a failure of management that can lead to materially misstated financial statements, and that can have serious legal consequences.
So let's bring this all home. We've gone through the mechanics, but why should you, as a future decision maker, care so deeply about this? It's because the value of these assets as reported on the balance sheet has profound, real-world consequences for how a company is valued, how it's perceived by investors, and how it operates day to day.
An impairment loss is not just some abstract accounting entry. It's a direct, massive hit to a company's bottom line. Imagine telling your shareholders you have to recognize a $50 million loss. That $50 million comes straight out of your net income for the period. It can easily wipe out an entire quarter's worth of profits and send absolute shockwaves through the stock market. It's a very public, very painful signal to investors that a major capital investment has failed to deliver its promised returns.
So the bottom line is this: failing to properly and honestly account for depreciation and impairment is a hallmark of poor financial stewardship. It results in inflated asset values and overstated profits, which can create a dangerously false sense of security inside the company. Managers might make terrible decisions, like taking on too much debt or paying out unsustainable dividends, because they're looking at faulty numbers. It's like trying to navigate a supertanker in a storm with a compass that's off by 20 degrees. Eventually, you're going to hit the rocks, and you're going to destroy investor confidence, which is the most valuable asset of all.
And this is the final thought I really want to leave you with today. Ultimately, the way a company manages and accounts for its physical assets, its planned assets, is a direct reflection of its leadership's character. It shows their honesty, their foresight, and their discipline. Is the management team confronting the tough economic realities of their business head-on? Or are they trying to hide problems and just kick the can down the road? As you go forward in your careers, learning to read this story within the financial statements is one of the most powerful analytical skills you can possibly develop. It will help you separate the well-run companies from the ones that are heading for trouble.